Really, the story of the day, I'd have to say, is the prospect of rising yields.
Well, I think it's an interesting term, particularly after we've had a really strong start to markets in the first week of January. There are clearly some issues that investors are beginning to look at, but for me, I think one needs to guide in the inflation outlook. It's all going to be about how the inflation prints come through from a fundamental point of view, and whilst the market might be positioning for worse inflation data, I think that from a fundamental perspective, that's what needs to be focused on most, and Friday obviously is a key date for that. Yeah, US CPI, big delivered on Friday. If inflation starts to tick higher, if yields start to go higher, how does that change how I invest in equities? Well, I think obviously it will have an impact. Always when markets move away from the perceived view, you get changes. So I think the initial position will be that markets will probably sell off if we get a big tick up in yields and the inflation data comes through stronger than expected. But I think as long as it's measured, equities will still be okay in the medium to longer term.
Isn't that the trade-off, Mark? I mean, if I'm sitting here with cash to put to work, the last thing I want to do is put it in bonds if we're looking at a bear market here, especially if I'm not going to get any return anyway. The only place to go is equities.
Yeah, I mean, obviously, as an equity investor, I'd have to agree with that. But I think what tends to happen is that when you get the kind of shock effect initially, it affects all asset classes. So I think it will actually give you probably a better opportunity on a very short-term basis, perhaps a better opportunity to buy equities a little bit cheaper.
But in terms of how I position within the market, I just want to get this chart up so we can show you what is going on here. If rates go higher, how does that affect my kind of cyclicals, value, balance? Cyclicals have been doing relatively well. Financial, you saw it yesterday in the S&P. Market sold kind of bond proxies and bought into financials, etc. Kind of, is that the rotation that you would now expect to start to really sort of gain even more traction?
Well, I'm not sure. I think in general, cyclical assets and growth assets actually tend to do quite well in rising rate environments. Okay. Because we're seeing continued and stronger growth than expected coming through. So apart again from the initial shock factor, I think we will see growth assets in particular doing very well in a steady rising rate environment.
But it's all about the delta, it's all about the rate of change.
Correct.
And in terms of how does this work from my geographical point of view? Is the US is later in the cycle? Do I kind of rethink what I'm doing in the US versus what's happening in Europe? Europe doesn't have much tech. We'll talk about tech a little bit later on. Is that a hindrance in this kind of environment? How do I position myself around the world?
Well, I think we've already seen from a US equity point of view, we've obviously already seen the tightening cycle beginning, so some of the shock factor is already built in there. If we were to start to see that occurring in Europe or in Japan, then you've probably got the shock factor to come. So it may seem counterintuitive, but I would probably favour US equities.
When I look at the possibility of buying equities, I always think from a value perspective. Maybe that's just because I'm a bargain hunter by nature. U.S. equities seem to be pretty highly valued. I think last time I checked, 23 times forward earnings compared to 15 or 16 times forward earnings here in Europe. I realize there's a mixed difference, right? More tech stocks in the U.S. But what do you think about value hunting in this market?
Okay, so I think you've got to stick to strong fundamental work. And if you look within, I mean, from the sector I cover, which is technology, so the sector I have the most knowledge about, I can see that certain parts of that sector look quite stretched compared to history. Semiconductors, for example, where EV/EBITDA multiples have gone up to well over 13 times from a low in 2011 of 5.5 times. So they've had a big valuation increase. But if you look at big cap tech more broadly, it's actually trading relative to the S&P at the lower end of its range because some of these growth assets, these big growth companies, have not re-rated. In fact, according to a piece of research by Bernstein put out over the turn of the year, big cap tech has actually derated slightly in the last 12 months in spite of share price performance.